This diagram represents classical economics' baseline assumption, Homo economicus. It depicts a perfectly rational actor who calculates risk and return to maximize utility. The expected flow is straightforward. An individual receives information, calculates their personal financial needs, and produces an optimal, logical financial decision. But empirical data consistently disrupts this theoretical framework. In practice, real human beings do not act like rigid algorithms. To explain the gap between theoretical math and actual human choices, economists developed behavioral finance. Built on the foundational work of theorists like Daniel Kahneman and Amos Tversky, this field measures what traditional economics ignores. The central premise is that psychological factors and cognitive biases consistently override objective, rational calculation. Traditional economics fails to predict reality because it relies on mathematical perfection while ignoring the psychological influences on the human brain. To test this premise, we analyze multiple linear regression data from two vastly different economic environments. First, we examine the macro-level wealth accumulation operating within large-scale capital markets. The subjects for this environment are university accounting students, a specific demographic explicitly armed with formal financial education and market training. Second, we look at micro-level daily operational wealth management. Here, the subjects are small and medium enterprise operators, specifically rural flower farmers running their own business. These datasets allow us to observe how objective financial knowledge competes against subjective psychological traits. If the data shows that rational knowledge fails to drive behavior in both groups, the trained investor and the rural business owner, it suggests that psychological bias is a more reliable predictor of economic choice than formal education. We begin with the first case study, conducted by Rameshwar, Sandri, and Hidayat, which isolates the capital market decisions of those accounting students. These subjects serve as a crucial control group. They have been formally educated on market fluctuations, risk analysis, and financial planning. By traditional metrics, they should act logically. This diagram shows the researchers' theoretical model, pitting rational variables against psychological ones. The primary rational variable is personal financial needs, the logical calculation of target returns. Tested against this are three psychological variables: herding, overconfidence, and risk perception. This regression model forces a mathematical showdown. Do these educated individuals act on their calculated financial needs, or do their psychological biases take over? This table presents the multiple linear regression output from the study. The metric of proof here is the SIG column. A p-value greater than 0.05 indicates no statistical effect on behavior. The rational variable, personal financial needs, yielded a significance value of 0.206. Despite knowing how to budget, these calculations did not actually drive their decision to invest. Overconfidence also failed to influence the outcome, returning a SIG value of 0.664. This indicates the demographic lacks the self-assurance required to act independently on their own analysis. Possessing formal financial education and clearly defined personal goals is statistically insufficient to trigger independent, rational investment action in this population. We must then look at the variables that actually achieved statistical significance below the 0.05 threshold: herding at 0.006 and risk perception at a flat 0. In this context, herding is the act of abandoning personal data analysis to follow the decisions of the majority. Under conditions of financial uncertainty, the human brain prioritizes the psychological safety of the crowd over independent data. The second statistically significant driver is risk perception. A heightened sensitivity to potential threats actively slows or stops decision-making. This chart visualizes Kahneman and Tversky's prospect theory, specifically the concept of loss aversion. The psychological pain of a potential loss mathematically outweighs the joy of an equivalent gain, leading to extreme caution. In capital markets, formal education is eclipsed by primitive instincts, the compulsion to follow the herd, and the asymmetrical resistance to losing current assets. We now transition from the macro investing environment to the daily microeconomic operations of a small business. The second case study, conducted by Astuti, Rosiata, and Fayada, analyzes the financial management behavior of rural flower farmers.
A common professional assumption is that poor management among small business operators is a direct result of low financial literacy. To test this, researchers isolated 3 variables to predict good financial management: formal financial knowledge, Big 5 personality traits, and financial attitude. This table reveals the regression output for the SMU operators. The formal financial knowledge variable fails completely, returning a p-value of 0.266. Knowing the mechanics of budgeting, credit, and insurance is statistically irrelevant to whether a business owner actually executes effective financial management. The innate personality variable also failed to reach significance at 0.145. The only variable that dictates behavior is financial attitude, showing a highly significant 0.002. The beta coefficient for financial attitude is 0.495, demonstrating the statistical weight this single variable carries over all others. Financial attitude describes an individual's internal mindset, the psychological interpretation and continuous motivation required to actively monitor and manage their own financial standing. Having rote knowledge is like possessing a map. The map provides no value if the internal drive to navigate the terrain is absent. In the daily operation of a business, success relies on a proactive financial mindset. Rote knowledge remains inert without the attitude to apply it. Combining the findings from both the student investors and the rural entrepreneurs provides a consistent view of economic behavior. This empirically backed behavioral framework replaces the rational actor model. Market participation is driven by herding and risk perception, while operational management is driven by financial attitude. We must remove classical rational inputs, like financial knowledge, from the center of our models. The failure of the rational economic actor is not an anomaly. It is a statistically demonstrated feature of human psychology across disparate demographics. These regression models show that human economic behavior is a psychological process. Treating wealth management as a pure mathematical calculation results in models that consistently fail to account for how humans actually manage wealth. These academic regressions provide a warning for real-world policymakers, educators, and financial advisors. Educational programs that merely provide data without addressing deep cognitive biases are statistically unlikely to change actual behavior. To change financial behavior, providing a spreadsheet is insufficient. Effectiveness requires re-engineering the individual's psychological attitude and accounting for the inherent power of the herd.